Good afternoon, everyone, and welcome to Financing Greenhouse Homes in Dynamic Times. My name is Rachel McLean. I am the marketing specialist with the Greenhouse Project, and I am very pleased to welcome and introduce Kelly Bougere. Kelly is a senior loan officer with Capital Impact Partners, and she has been working with Greenhouse Homes for over 5 years. She is going to share a wealth of information, so we're really looking forward to that. And after the webinar, I am going to send out a PDF of the slides and a recording of this webinar to everyone who is registered. Everyone is going to be muted during this webinar to keep background noise to a minimum. And if there's any questions, you can feel free to use the chat box on the right of your screen, and Kelly will be able to answer your questions throughout the webinar, and toward the end we'll make sure that everybody's questions are answered. So with that, I'm going to turn it over to Kelly, and thank you for a great presentation.
Great. Thanks, Rachel. Okay, well, welcome everybody. I'm glad you all could join today. I know there's some additional dings coming in, but we'll get going, and hopefully folks can get up to speed. So we're going to be talking about financing greenhouse homes, and I'll just walk through some of what I'm planning to talk about here, and hoping to use a pretty good chunk at the end for questions. So you can either enter your questions into the chat box, or you can hold them to the end, and we can discuss them there as well. So first, I'll just give you a little bit of background on what Capital Impact Partners, my organization, is and does, and my role there. And then talk a little bit about determining your capital needs for your greenhouse project. Then I'll give you a quick overview of what capital impact financing options are, and we'll go through some of the types of loans that you've probably heard of related to greenhouse projects. And then we'll discuss the current funding environment, which everybody knows is a little bit uncertain right now, so we can talk about some of the issues there, and then address any remaining questions. So I will start with just a quick overview of what Capital Impact Partners is. So Capital Impact is a nonprofit community development financial institution, or CDFI. It's basically a fancy way of saying that we're a mission-driven lender. So in addition to typical lender requirements and interest rates and returns, we also look for a social impact in the projects that we finance. We operate nationally around the country, and we finance projects in several different sectors. Those include healthcare, housing, education, healthy food, and cooperatives. And financing projects that serve elders. It's an initiative that we call Aging in Community that kind of crosses a lot of those different sectors. So it crosses the healthcare sector and the affordable housing sector and the healthy food sector. So this slide just kind of gives you some of our stats of what we've financed so far. Overall, we've deployed over $200 billion in our 30-plus year history, serving nearly 5 million people across these different sectors. Specifically in the aging and community area, and this is more recent, we've deployed $28 million into 187 age-friendly projects, serving 14,000 elders. And those actually cross a bunch of different types of projects. So they include things like skilled nursing facilities, adult daycare, assisted living, Also healthy food projects that are serving a significant elder population, cooperative kind of in-home care organizations that are serving elders. So it crosses a lot of different types of projects. And just to give you a little background on why I'm here talking to you guys. So Capital Impact Partners have a really close relationship with the Greenhouse Project team. You know, many of you have heard about kind of the history of Greenhouse. The model was conceived by Dr. Bill Thomas more than a decade ago. And when it got its initial large chunk of funding from the Robert Wood Johnson Foundation, it kind of needed an institutional home to be able to incubate the model and really grow it and replicate it. So Capital Impact stepped in and provided that home, I think around 2005 or 2006. And then for the next 10 years, Greenhouse Project team was basically housed under Capital Impact's umbrella and, you know, grew its model from within that organization. And then about a year ago, as many of you know, they moved on to a new and, you know, I'd probably say better home at the Center for Innovation, and they're really taking off, and it's exciting to see the growth that's happened over the past couple of years. So Capital Impact continues to work closely with the Greenhouse Project team. We're just no longer part of the same organization. And I'll say over those 10 years that we were part of the same organization, Capital Impact's lending side, financing side, was also making loans to Greenhouse Project while the Greenhouse Project team was kind of providing the technical assistance side of things. And in terms of past projects that we financed, this is just a handful of them, but you know, we provided loans to these projects: the greenhouse homes at Mirasol in Loveland, Colorado, Water's Edge at Willowbrook in Mankato, Minnesota, the Harry and Jeanette Weinberg greenhouses in Detroit, Michigan, and the Mustard Seed Project, which is still a project underway on Key Peninsula in Washington. And I'll talk about a couple of these later and kind of what the financing structure was with them and in relation to the types of things that we can do. So I'll move on and talk a little bit just about as you're starting to think about your greenhouse project and kind of determining your capital needs, kind of what that entails. Thinking about really what kind of capital do you want to pursue? And it begins early in the concept phase. I will take this opportunity to make a plug for the Greenhouse Project team's financial feasibility process that really helps you kind of wrap your head around this and kind of determine what your capital need is and what the best type of capital might be and what your projected cash flow will be to be able to support whatever you decide to take on in terms of debt or equity. So this first piece, you really need to start by developing a preliminary project budget to determine the overall cost. And, you know, in the FFM process, they'll really give you a sense for construction costs in your state, and you can apply that estimate to your project kind of general parameters, you know, the number of greenhouse homes you're going to build, the square footage you're going to have. It's a good starting point, and then eventually down the road you end up bringing on a general contractor who then bids out the project and you get much more detailed numbers. But in the beginning, I think you can do a pretty good estimate based on historical costs in the area that you're planning to build in. So the project budget includes, you know, the hard construction costs, the soft costs, which are really basically anything outside of those direct construction costs. So things like market studies to show the demand in your area. That's often something that funders will require. Environmental reports on the property you're planning to develop, architecture and engineering reports and fees and various services that they provide, legal costs, consulting costs, etc. FF&E, furniture, fixtures, and equipment. So for greenhouses, that's things like the lifts and the kitchen appliances and all of that good stuff should also be in your budget. And startup costs and reserves are important. And I'd encourage you to think a lot about the ramp-up period for your greenhouses, and I think this is also part of the financial feasibility process that Greenhouse takes you through. But it's an important one because what we've seen on projects that we finance is that move-ins for residents definitely happen at a much slower pace in greenhouses than they typically do in a regular, skilled nursing environment or assisted living environment, because they really want to give residents a chance to get used to their new environment and get settled before the next one comes in. So culturally, that's a really important piece of the greenhouse model. Financially, it can be tough in the beginning because you are bringing on almost full staff and already incurring operating costs, but you're taking a much slower time to ramp up your revenues to cover those costs. So when you're thinking about your project budget, it's always good to think about whether or not you need to include startup costs or reserves to cover those that period of time in your budget. And then contingencies are always a big one as well. So just reserving some additional cash for unforeseen issues with construction or soft costs or assessment. I gave some examples. Our typical requirements are to see 10% contingency on hard costs and 5% on both soft costs and finance and FF&E. So that's the first piece of it. Once you've got that budget put together, then you're going to start considering whether you want to look at debt versus equity. Something to really think about is that the debt, if you go the debt route, you're still going to be required to put in 10 to 20% of equity. And you can think of it similar to if you were getting a mortgage on a home, you'd assume that you'd probably have to put down 10 to 20% in cash to be able to get that mortgage. So same concept here. And, lenders, from a lender's perspective, we usually require that for a couple of different reasons. One is because often lenders are kind of limited by a certain loan-to-value ratio. Basically, they don't want to go above, say, 80 or 90% of the appraised value of the property. So whatever's remaining would have to come in as cash for equity. And they also like to see some skin in the game. An investment from the borrower that says that they are also putting their money at risk as well. And when we talk about equity, that can include a lot of different sources. So things like cash reserves. So if you're an existing operating company and you have, cash flow and you have cash reserves, you can put some of that towards the project. It could also come in the form of grants. Donated land value is one that we often see. Capital campaign fundraising, or even cash raised by third-party equity investors. And we can talk about that in a little bit as well. And as I mentioned, the financial feasibility model is really going to help you estimate your need. It'll have you project out your cash flow. It'll take your development budget. It'll say, this is what you can support in terms of debt based on these assumptions, and this is the need that your budget is showing right now based on the amount of equity that you have available. So it's a very helpful process to get you to that point. And then once you decide on what you'd really like your capital sources to be, you then want to go back to your project budget and revise it based on that. So with things like debt, you may need to put a reserve in the budget for making debt payments during the construction period because you won't have an operating project to be able to make those debt payments. So oftentimes people reserve those payments in a lump sum up front and then pull from that reserve during construction to make the debt payments. And then they start paying out of cash flow once the project is operating. And other things like transaction costs, loan fees, title and recording costs, et cetera, those can add up a little bit in the budget, so it's important to plan for those as well. So I wanted to talk just about, the caveat is that I am a lender, so I'm probably going to focus a lot more on debt than equity in this presentation. But I wanted to give you a sense for what the spectrum is of available sources of debt. And it definitely ranges by the type of organization you are, the type of greenhouse you plan to operate, where you're located, all of that. So this is kind of the four major buckets that we typically see available for greenhouse financing. And I'll start with bonds. So bonds are typically good for large projects, and they're usually best for established organizations. Organizations that are able to get bonds have, a strong operating history, they are, they've got a track record to show. It's relatively low-risk organizations that are getting this type of financing. And there's both public and private issues. With the public issues, the money is raised by a city or a state or some other public entity. They issue the bonds, and then they take those proceeds and they reloan that money to your organization to finance the project. And there's a couple of different types here. I'm sure there are other types that I haven't included here, but basically the difference between general obligation bonds versus revenue bonds is kind of what's anticipated to pay back the bonds themselves. So with general obligation bonds, the issuing entity is going to be basically taking on that obligation, and they are required to pay them back however they can. That usually means with tax revenue. In reality, they're getting payments from your project and then paying them back. With revenue bonds, they just typically guarantee those bonds with the revenues that they anticipate coming from the project. So it's just some different structures, but kind of the same basic idea. Something else I'll mention on bonds, a lot of times we see organizations that may be using them to refinance a couple of different projects, so consolidating their debt from a few different projects into one large bond issue is something we see often, or even just financing a couple of different constructions at once. So it's a good source for large projects or for consolidating projects. There are also some government-backed programs, and I am not an expert on these, so if you have specific questions on them, I probably can't answer them, but in general, I just wanted to make sure that you were aware of them. There's programs through HUD, Housing and Urban Development, through the USDA, which is the Department of Agriculture, through the SBA, which is the Small Business Administration. And then there are a lot of federal, state, county, city programs that also provide financing. So it's important to look at what's available in your area, and these typically have specific eligibility requirements. So if you're using USDA financing, they usually have requirements for the area that you're in. It's got to have a certain population of, I can't remember the requirements off the top of my head, but something like 50,000 people or less in the area that your project is located. But they're usually very favorable terms and great sources if you can get them. Then you move into kind of the traditional loan bucket, which is your typical bank financing. So similar to bonds, this is best for established organizations with strong banking relationships, strong operating history and track record. Banks have specific boxes that they like to fit projects into, and so if your project is kind of standard with a good LTV and good cash flow, and you've got a long history and everything's kind of tied up with a bow, that's a great source. And they always, they usually have pretty good interest rates and terms, and so I think the big difference between traditional loans from a bank versus bonds is that the traditional loans from a bank are probably going towards, the single standalone projects. They're not really consolidating projects like bonds might be. And then, all the way to the right of the spectrum is the non-traditional loans, and capital impact falls squarely in that category. So other CDFIs, community development entities, CDEs or CDCs, community development corporations, or other local community loan funds. All of these lenders are typically mission-driven, as I mentioned, so they're looking for a social impact in addition to their normal return. And they're also typically more flexible on terms and operating history and things like that. So they're not going to have that rigid box that the banks have in terms of what they look for in a project. And then I just wanted to talk about what a typical financing package includes. When we're talking to a project and they give us all of this stuff and they have it all prepared, I think that's a great sign. It shows that they're very organized and that they're prepared for the financing process, which can be kind of complicated and long. So having this stuff prepared ahead of time before you approach financing entities is is really a great start to the relationship, I would say. So some of the typical stuff you probably expect to see here: a summary of your organization, if there is one, or if you're an existing operating entity, the scope of those current operations, bios and resumes of your management, as well as 3 years of your historical financial statements plus the year-to-date statements. And then on the project side, looking for a project description, the project team bios and resumes. And the project team usually includes a developer, if there is one, the general contractor, the architect, the project manager, and any management you've already put in place for the greenhouse operations. You may not have all those people in place when you start looking for financing, and I think that's fine. That stuff will come over time, but whatever you do have, you should provide up front. And then the project timeline. So where are you in the process? How long do you expect to take until you can break ground for construction? Something to always think about that comes up in almost every project I work on is the timing it takes to get building permits, which seems like something that is not a big deal, but it ends up being a big deal because that timing differs so much across cities and states and different municipalities. It's amazing. So I've been talking to somebody in Arkansas who can get a building permit in a week. I was talking to somebody else in Vancouver, Washington, who said it takes minimum 90 days to get one. So it can really drive your timeline because a lot of funders don't want to close on financing until those building permits are in hand. And then also on the timeline side, just how long is your construction going to take, is the construction period, and then how long do you anticipate ramp up of the project to take until you get to full operation. Sources and uses of funds are really just the project budget and then the sources of funds you anticipate using. A market or feasibility study showing the demand of the area, and then 5 years of cash flow projections. And with cash flow projections, I'd encourage you to provide some of the assumptions you put behind those cash flow projections. So, what is your projected census in each year, your payer mix, your staffing plan and number of FTEs. And if you're working within the financial feasibility model, most of that is part of that. So it's helpful. It kind of lays all those assumptions out very clearly. And then I just put down some additional things to think about that come up frequently when we're talking to folks, things that you may not have anticipated needing when you're talking to funders, but that become important down the road to them. So things to think about up front. Loan guarantees are one big one, especially if you're a startup greenhouse. We, at least as a lender, are looking for some sort of experienced entity to be involved in the project, and they may be, involved as a consultant. They may come in as the actual operator of the greenhouse, but part of that is also asking that entity provide a guarantee for the loan. Another thing to think about is that if you have a company that has, private ownership of, 2 or 3 people, those individual people may be asked to provide personal guarantees for a loan. Another thing is on cash reserves. So I mentioned that you often, with debt, you want to reserve some money to be able to make interest payments during the construction period on the loan. Some lenders may also ask you to put aside some money as a debt service reserve that just kind of sits there and is available in case the project runs into trouble and can't cover the debt payments itself. So that is a different type of reserve. If you're a startup greenhouse or a startup organization in general, that's probably going to be something that is required of you. If you're an existing operating entity and you can show that your existing operations could cover debt payments without even bringing on the additional revenues of a new greenhouse project, then you're probably not going to have that additional debt service reserve. And then just on the equity side of things, if you are looking at bringing in other equity investors outside of you or your existing operating company, just think about what that does to your cash flow. Cash flow distribution to equity investors can make it difficult to reinvest or grow because you're distributing a fair amount of cash out instead of retaining that in the company. So kind of modeling out what that looks like over time is important, and kind of comparing that to perhaps debt options and equity options and some combination of the two. What does that do not only to your budget, but your project cash flow as well? Something else I wanted to mention that is a relatively minor detail but also becomes kind of a big deal if people don't address it early is construction payment and performance bonds. Most lenders, including Capital Impact and probably almost any other lender you talk to, requires that your general contractor have a payment performance bond that basically ensures that the project will be completed even if that contractor can't do the job themselves, or if something catastrophic happens, it's insurance that the project will be completed. And those can be costly in some situations and can take a long time to get in other situations. So it's just something to have on your mind early and to make sure it's somewhere in your budget as soon as you're able to get some sort of estimate for cost. Usually what we see is the cost is somewhere between 1% and like 4% of the hard costs associated with the project. And then lastly, just think about the timing of sources of funding. So if you're putting in cash or equity, usually that is expected to go in first into the project before the other funders are willing to disperse their money. So sometimes, people will think that, once they use all the loan proceeds, then they will put in their own money, but it's actually the reverse. So it's something to plan for ahead of time. So I will talk a little bit about Capital Impact and what we have done and what we can provide. Just in general, our typical loan amounts range between $1 million and $6 million. We can go above $6 in the right situation, so we're not limited by that, but this is sort of, in general, where we usually land. And we can do all the typical loans that you usually see associated with projects. So acquisition loans, tenant improvement loans if you're planning on doing a leasehold rather than owning the property, construction loans, term loans. And then I think there are some types of loans that we do that other lenders probably don't typically do. One is a bridge loan. So sometimes we will be bridging grant financing that's expected to come in later, but that is needed up front to finance the project construction. Or things like tax credit equity investment, which also comes in later at completion. We'll provide equipment loans to purchase equipment, and then we also leverage government programs. We are a participant in the New Markets Tax Credit Program, which some of you have probably heard of. And we also receive bond financing that is guaranteed by the federal government. So we then turn around and lend that money out to organizations at a fixed rate for a long term. So that's a great source of capital. And I'll talk about some of those in a little bit. Our general criteria, I've talked about some of this already, but overall Capital Impact is committed to supporting the creation of strong and sustainable greenhouses that serve a significant proportion of low-income elders. So that's the mission piece of what we do. What makes a project strong and sustainable? Well, as I mentioned, we like to see an experienced operator managing the project or brought in to help with the project. So, if it's a startup greenhouse, looking for them to have some sort of partnership with an experienced operator to make sure that there's an experienced hand in the new venture. Also looking for a development team that has good experience, or if the development team doesn't have a ton of experience, maybe they will have access to technical assistance or consulting that can kind of lend that additional experience to the project. Access to equity equal to at least 10% of project costs, which we talked about before. And then just a commitment to the greenhouse model. You know, Capital Impact itself is very committed to the greenhouse model. We've seen the quality that it produces, and when something is a certified greenhouse, we know that that quality assurance is there. So we're really looking for greenhouses that are, you know, committed early, even though sometimes it's a slog to get to the finish line, that they are definitely going to pursue the model and not end up pursuing some sort of version or variation or different model. And then on the low-income piece, how do we actually define that? So there are two different ways that we define it. One is that we look at the proportion of residents in a greenhouse home that are at or below 80% of the area median income. And the AMI differs from city to city or location to location. I gave an example here, Washington, D.C., single person in AMI, which is pretty high because it's a relatively high income area, $61,000. For a resident to qualify, they would have to have an income of $49,000. The other way that we look at low income is simply eligibility for Medicaid. So I think our rule of thumb at Capital Impact is we typically look for around 50% of more of the residents being at or below 80% AMI, or 40% or more of the residents eligible for Medicaid. So those are rules of thumb. There may be other lenders in the sort of non-traditional loan space that I was talking about that have different requirements. So it's important to talk to folks about what their mission requirements are and kind of what they're looking for. And one thing we do a lot of is New Markets tax credit transactions. And a lot of you have probably heard of them. They are, you know, people see really big, beautiful greenhouse campuses that were constructed using New Markets tax credit financing, and they hear all the great things about it and kind of want to get in on the action. So I thought I would spend a little bit of time going over the program, giving you a sense for what it is, and you know, talking about both the benefits, of which there are many, as well as some of the drawbacks to it. So just kind of the basics. The terms of a New Markets tax credit loan, basically the loan is typically $5 million or more. And we really don't recommend looking at New Markets tax credits if you are working on a project that needs less than $5 million in financing, just because of some of the things I'll talk about in a little bit. But it's a long process. There's a lot of transaction costs, and the benefit, you just can't really maximize the benefit if you're working on a very small project with it. The term of the loans is 7 years. Interest rates are fixed over that period, and the repayment is interest only. So you're not paying down any principal on the loan. You're really just making interest payments, and then at the end of the 7-year term, you'll have some debt to refinance, a balloon to refinance at the end. The benefits of the New Markets program are that it's usually a very favorable rate. It's a blended rate among a couple of different sources of capital, so it ends up being pretty low. There's a potential for high loan to value. I talked about before, a lot of lenders don't want to go above, you know, say 80% loan to value, while with New Markets, the end loans to the borrower are usually at or above 90% loan to value. So it provides flexibility there. It minimizes debt payments because you've got a low rate in combination with interest-only payments. So your actual debt payments are very low over those 7 years. It gives you a chance to ramp up your project and really get your operations stabilized. And the most popular benefit is that there's a potential for 20 to 25% debt forgiveness at the end of the 7 years. And in the next slide, I'll show you how that works. And then the New Markets program does have some eligibility requirements. So your project location must be in an eligible New Markets census tract. And there are some pretty easy, if you Google a lookup for that, you can probably find it. But there are some pretty easy websites to plug in an address and see if it qualifies. There are two kind of levels of eligibility. There's a distressed census tract and a highly distressed census tract. Both are eligible for projects, but I'll just let you know that these days New Markets are relatively competitive, and most folks are looking for projects in highly distressed census tracts. So something to be aware of You can also qualify if your project serves targeted low-income populations, and that could be, employees, the owners themselves, or customers. I think with greenhouses, we're usually seeing the targeted population in the employees and customers. And it's important also just to note some of the drawbacks for the program. So one is that, as I mentioned, it's incredibly competitive. There are a limited amount of tax credits out there that can be allocated to projects. And there are a ton of projects that want to take advantage of the program. And I see a question from Stephen here about potential debt forgiveness. And Stephen, I'll mention that in the next slide. I have a little bit of a structure chart that I can walk through and show you how that actually works. Another drawback is that the structures are really complex. And so there are a lot of lawyers involved and a lot of accountants involved, and that results in a lot of transaction costs. The end benefit is definitely worth it. The debt forgiveness piece and the other benefits that I listed here, they're worth the transaction costs, but it is a tough pill to swallow up front. So it's something to be prepared for. And these can take a really long time because they're competitive, because there are a lot of parties involved. It could take 2 or more years just to put together a new markets transaction. I'm working on a greenhouse in Arkansas right now, and I've probably been talking to them for about 3 years about this transaction, and we're just now getting ready to close. So it's been a long time coming. So I'll give you a sense for what the structure looks like. This is very simplified. The charts are usually a headache to look at, but the general concept is relatively simple. So you've got a lender and an equity investor in every new markets project. The lender, say you need $4 million to finance your greenhouse project. The lender puts in $3 million in debt, and that's debt that needs to be repaid eventually. And the investor puts in $1 million. And what the investor is doing is purchasing tax credits. So they're paying $1 million. In return, they're getting tax credits that they can apply against their income taxes over those 7 years of the loan term. And so they're not really looking for repayment because what they've done in this transaction is purchase credit. They're not putting in debt. So you get $4 million pooled into what's called a community development entity, and then that $4 million was lent out to the project. So over 7 years, the project is making debt payments, which are interest only, on $4 million. At the end of the 7 years, though, they've only got that $3 million to refinance. So they don't have to refinance the full $4 million. That extra $1 million is essentially forgiven. It's a little more complicated. There's a lot of assignments of funds and stuff like that. But the end result is that it's forgiven, and the $3 million is what you actually have to refinance. And I see a question from Marcia, investor. So the equity investor is usually like a big bank, and they are investing in the project. So even if the end project is a nonprofit, the equity investor is typically a for-profit, and they're involved in the transaction because they are purchasing tax credit. That is their motivation for putting their money into the project. So this whole vehicle was basically created to incentivize private investors to put money into community development projects, often which are for nonprofit entities. So I hope that helps a little bit. So I'll give you an example. This is a past project we did with New Markets tax credits. It's the greenhouse homes at Mirasol in Loveland, Colorado. I know they do a lot of tours, so some of you may have done tours on their campus in the past. And I think we closed this in 2013. So this is kind of what that structure looked like. We had a lender who was actually Capital Impact, put $5 million in. They actually had a grant that they could also kind of leverage through the structure. And then there was an investor that paid $3.4 million for their tax credit. So all of that money pooled together and went into the project. And they also had additional money in the form of direct loans and grants and equity direct to the project as well. So this gives you an idea that the structures actually end up being more complicated than the way I described them. But in general, kind of this is how this transaction looked. if you look at it kind of from a chart standpoint. But it was a skilled nursing greenhouse campus, 6 homes, 10 beds in each home, so 60 elders total, and 1 administration building, so 7 buildings total. And it was a partnership between the Housing Authority of the City of Loveland, which acted as kind of the project sponsor, as well as guaranteed the loan, which was important. And then they brought in a separate operator, Vivage, to operate the greenhouses. Another loan product that Capital Impact has for greenhouses is under our Age Strong Fund. It's a partnership with the AARP Foundation, AARP, and the Calvert Foundation. It's really cool because the Calvert Foundation sells community investment notes to anybody. You know, you could go to your retail broker and buy a community investment note. I think you can buy them online now. And so those individual notes are pooled together into a loan fund, and then we lend them out to projects that are focused on increasing access to quality services for low-income individuals that are aged 50 plus. So it's kind of direct investment from people, average people like you and I, and their money is relent into some pretty neat projects. So the loans under this fund are great for some of the types I mentioned before: equipment loans, tenant improvement loans, term loans, construction loans. They have a competitive interest rate, and they can go up to $5 million. So this is kind of the standard. If we're not doing any market tax credit project and we're just doing a typical standard loan, this is the fund that we use for that. This is a project that we just financed with the Age Strong Fund. It's the Harry and Jeanette Weinberg greenhouses at Rivertown in Detroit, Michigan. And the sponsor is Presbyterian Villages of Michigan, who you may have heard of before. And there was actually a webinar on this project. The greenhouse folks did a webinar on, I think, last week to talk about it because it's a really unique partnership with PACE of Southeast Michigan and Presbyterian Villages of Michigan, where PACE is, the PACE program is paying a daily rate to the greenhouses for full occupancy, and then populating the greenhouse homes with all of their PACE. You know, the homes are entirely PACE enrollees. So it's a really interesting project, and we were excited to be a part of it. It was assisted living, 2 homes stacked on top of each other because it was an urban environment, 21 elders in downtown Detroit. And the project was with a large existing operator. So Presbyterian Villages of Michigan already operates a few greenhouse campuses already. And I gave you a sense for what the capital stack looked like here. They had a lot of grants and cash equity to put toward the project. We don't usually see this much. So the Age Strong loan was $4.5 million, and they filled the rest of the $9.4 million with their own cash and grants and various loans from affiliated entities within PVM. So it was a unique structure. You know, we do work on smaller scale projects other than the ones I've just talked about. Say you may have a $4 million project, may put in $400,000 in equity and then get a $3.6 million loan. So things like that are typical as well. It's not always a ton of cash and equity going into the project like you've seen in these past 2 that I showed you. And then the last thing I'll mention is just our long-term loan product. So if you're an existing greenhouse operator, or perhaps are looking to refinance some portion of a greenhouse facility, this is a great product. As I mentioned, we use a federal guarantee program, so we're able to provide long-term fixed-rate loans. Can go up to $20 million, which is far above our normal kind of threshold. And there's a fixed interest rate over a really long period of time, 15 to 25 years, which is not typical. So you're avoiding the interest rate risk that has become, you know, kind of an important part of the funding environment lately. And something to note with this loan product, the loan amount is limited to 80% of the appraised property value. So I think, you know, folks that are have existing operations and are looking to refinance, things like that, definitely, you know, feel free to reach out to me and we can talk more about that. But this is really a good fit for that type of project. And so I will spend the last 5 minutes talking about current funding environment, and then we can, spend another 10 minutes on questions if folks have them. The title of this webinar is Financing in Dynamic Times, and so I think it's important for us to address some of the potential changes that could be coming down the pike, or some areas of uncertainty that we have felt recently with changes in administration and in the general environment. So at the federal level, I just wanted to point out kind of 3 buckets of possible impacts. I think there's still a lot of uncertainty around what's going to happen with budgets and with different reform programs that have been proposed. So this is all possible, certainly not definite. And I think we'll all just have to watch how things unfold over the next few months or even the next few years to see what actually happens. But so I'll start with the federally backed loan program, which I talked about earlier. A lot of those agencies are seeing a lot of changes with the new administration. The White House put out a budget recently that showed a lot of cuts to those agencies. So, some of those government funding programs that have really favorable terms, they may not be available in the future, or there may be some uncertainty around their availability. Another possibility is that eligibility requirements for them may change. Perhaps they get a little more strict. And then, there could also just be general delays in approvals or funding. And I see Marcia asked a question about where the USDA rural development loans fit in. I think that's a good example. So I've talked to a couple of folks, I don't know if any of them on the phone right now, but who are planning to use USDA financing for their greenhouse project. I was talking to somebody in Tennessee who said that they heard that there's some uncertainty at USDA, and their local USDA office wasn't really sure about what funding would be available or what the timing would be for receiving that financing. So, in the best case, I think the financing would be delayed. In the worst case, it would be unavailable. Somebody else that I've been working with in Kansas has had really positive conversations with their local USDA office and feels pretty confident that their USDA financing will come through in a timely manner. So I think there's a bunch of uncertainty around what is happening at those agencies, and part of it is also just that the staffing has changed over, and some staff have not been appointed or hired yet. So it's been tough to get consistent information around what is going to happen with some of these funding programs. So something to be aware of if you're working with USDA and looking at those programs. I think it's important to talk to your local office and get their take on it, and kind of look at what the budget plans are for the USDA agency. And the same goes for the other agencies we mentioned, like HUD and SBA. Another bucket of changes at the Medicaid and Medicare level. So a lot of us saw the American Health Care Act, which did not go through, but it proposed some significant changes to Medicaid. And that type of change could ultimately result in declines in reimbursement rates. So when funders are looking at your project, or when you're projecting your project out and talking about your ability to cover debt service, a decline in reimbursement rate is definitely going to impact that. Given that the AHCA did not go through, we don't really know what or when those changes will be, but something to keep an eye on, and something that lenders are also keeping an eye on. Some are wary of financing projects right now that are heavily reliant on Medicaid and Medicare. We are not one of them. It's kind of in our core base of projects, so we're not walking away from those types of projects, but other lenders are showing some concern around it. And then on the tax credit program side, New Markets Tax Credits is a great example. It's been said that those programs could potentially be eliminated to offset tax cuts that are planned in the tax reform program that the White House is hoping to get through. So it's possible that that happens. We think that new market tax credits have a really strong bipartisan base behind them, but it's something that we're certainly keeping an eye on, and the end result of that would be that private investors really lose that incentive to invest in community projects. So those are some pieces of it. And just the last slide I have here, I wanted to mention just some other changes to the funding environment that are happening. A lot of you are probably aware that interest rates have been rising recently. I gave an example here of the 5-year Treasury this month versus the 5-year Treasury a year ago, and it's gone up by more than 0.5%, which is meaningful if you have a large project and you're financing it with debt. So I mentioned the 5-year Treasury just because a lot of lenders base their interest rates in some way on an index like the Treasury rates or on LIBOR. So those are kind of a proxy to show how interest rates are rising. Good change, something exciting to talk about, is that there's a lot of increased recognition for the greenhouse model. So I think you're going to be finding a lot more options for financing as the model continues to replicate, and that's happening. I think it's kind of on an upward slope, and it's happening faster and faster. So as there's more recognition, I think you'll have a lot more interest from financing parties around providing funds for that. And then lastly, just the availability of grant financing. If you're a nonprofit greenhouse and you're looking for grant financing, I think that has fluctuated over time. We used to see a lot of grants coming in from the Weinberg Foundation, for instance, and those have kind of gone down of late, or their grant size has reduced by quite a bit, or there's been delays in grant funding. So, fluctuations in the grant kind of market are definitely impacting projects as well. So that's all I had. I see there's a couple of questions that I haven't gotten to. So Stephen asked how a full established greenhouse is appraised, income approach, or comparative market value. And Stephen, I'll just say we usually look at both approaches. So in the income approach, they're projecting out the net operating income and then kind of using that to establish the value of the greenhouse home. In the comparative market value, I assume you're talking about the sales comparison approach. Yeah, we've looked at both approaches. Sales comparison can sometimes be hard depending on what market you're looking at, because there may not be really comparable sales to look at. They may look at a regular nursing home, but in reality that is not that comparable to a greenhouse home. So there can be challenges in the sales comparison approach, but the income approach is definitely used. And then Brent asked, are there reimbursement rate reductions in the works for short-term recovery? I'm not sure I actually understand that question. So Brent, maybe you could just add a little bit of clarity. I'm not sure what you mean by short-term recovery there. And then Angela mentioned she has land in the Washington, D.C. area that aren't in CDFI or New Markets areas. So how would CNAs fit into the low-income employees to meet the loan criteria? Okay. Yeah, so there will be income, you're talking about the criteria to qualify a project for New Markets tax credits based on targeted populations rather than based on the actual location of the project. And so I don't know the specifics of what those requirements actually are, but it would generally be, income threshold for the CNAs that you're employing. I imagine that you would look for both the income thresholds of the CNAs and other staff that may fit into that income bracket, as well as your residents. So I think the combination of those two would be what you look at. But I can see if I can get, if you wanted to reach out to me, I can try to get you a little more detail on how that's actually done. So I think we went through all the questions. Let me know if there are any others, or Rachel, I don't know if you wanted to follow up on anything, but I think that's all I had for now.
Excellent. Well, if there are other questions, feel free to add them into the chat box. But thank you so much, Kelly. This was really great information. And like I said at the beginning of the call, it has been recorded, and I will send out this recording and a PDF of the slides for your reference later. It's definitely a good resource to refer back to. So thank you so much for taking the time and for sharing your expertise.
Great, sure, of course.
And before we end the call, I just want to let everyone know that the next webinar will be on May 11th, and we're going to feature John Knox Village, a greenhouse project in Florida, who will be talking about their experience and success offering short-term rehab in greenhouse homes. And they'll speak from an operational perspective as well as a marketing and building external relationships perspective, and also highlight some of their outcomes to date. So that should be really great. It's on May 11th at 1 o'clock Eastern Time. So go onto our website and you can register for that webinar as well. And with that, I'll just wish everyone a good afternoon.
Great. Thanks, everybody.
All right. Take care.